Welcome to the All Financial Hour podcast with Steve All.
President Trump, he has used the threat of tariffs as pretty much a negotiating tool here, but will he use them to wage a trade war that could result into more inflation? Well, here's Morningstar's economist Preston Caldwell.
My baseline assumption is that we don't see large tariffs implemented and maintained indefinitely. They could be implemented for, thinking about the 25% tariffs on Canada and Mexico or the 10% across the board tariff. That could be something that, comes and goes in a week. But is it going to be maintained for years on end and sustain a large, prolonged increase in inflation? That I'm more skeptical about.
Well, here's the thing. We could sit here all day, Steve, you and I, and go back and forth and try to think what the government's going to do. But here's the thing. We cannot control it. What we can control is our retirement savings. Even when it comes to inflation, there's ways that we can sort of inflation-proof our retirement. Would you agree?
I believe that the inflation side of it, we've always keep it about 3%, and people come in, want to run at 8, 9, 10%. And I said, it's not going to be that way. And they said, well, it is right now. I said, well, it was 18% back in the 80s, and it went down. So it's going to go up and it's going to go down. Inflation's always going to be a part of our lives. So the idea around it that I look at is that some people, interest rates are higher right now. CD rates are higher. But CD rates have never kept up inflation. I remember when my daughter was born and my dad wanted to go to the bank to buy a CD. And we walked into the bank and he complained because they only had an 8% CD for his granddaughter. Mm-hmm. And I'm going, how many people would love to see an 8% CD today? Everybody's raising their hands. So it's not going to stay high. It's going to go up. It's going to go down. I think the best inflation hedge is the market. Now, do you want to put every dime you have in the market? That depends on your risk-reward tolerance. And I think that's where people have to look at. How much risk are you willing to look at? A little? None, a lot, but we need more gains than what we can get from the current CD rates because they are going to head down. And a lot of people start to look at it, well, how does that affect annuities right now? If you need that guaranteed income to work with, you can buy more guaranteed income today than you could 5 years ago. Mm-hmm. And if you look back 5 years ago and you could have bought Apple, NVIDIA, and all these big companies today 5 years ago, could you have done it? Now you're looking back going, boy, I wish I'd have done it 5 years ago. Well, 5 years ago, the interest rates were almost nothing. Now interest rates are higher on the annuities. 3 or 4 years from now, when interest rates start to crawl back down, you go, man, I wish I could have bought something back then.
So how is a breakfast drink like risk in a retirement plan? I know it sounds crazy. Stick with me here. Before we answer, I need you to listen to comedian Gary Goldman.
My parents are from the greatest generation. They're amazing. They survived World War II, the Great Depression, the polio epidemic, pulp in their orange juice. Unregulated, unlimited pulp in their orange juice. Never said a word about it, never complained. Then we came along, took one sip. What was that? There's orange in my orange juice. Do something now. And they did. Tropicana rolled right over, got rid of all the pulp. All right, the pulp is gone. You crazy people, are you happy? The pulp is gone. There's no more pulp. Can we keep some pulp?
It's a good little bit there. I like that.
Hey, we also survived garden hoses.
Oh, yeah, drinking from the garden hose. Yeah,
bicycles
sure.
with no helmets.
That's right. Yeah, God, riding in the car with no seatbelt.
And running around, well, standing in the back of a pickup truck.
Yeah.
Riding in the back of the pickup truck. And I got to say, how many people remember riding in the back window?
Oh, you got me there.
When you're a little kid in the cars.
You got me on that one.
That's my generation, so it comes from there. So,
wow.
Pulp.
All the things we've survived in orange
that
juice
is
pulp
a big one,
nearly
though.
took us down.
My wife likes it pulp-free, and I like
me
the
too.
pulp.
Oh, gosh. No, I'm the pulp-free person. I get it.
No.
I mean, I guess if you don't have a choice, you just roll with it. But,
Yeah, but I do.
Yeah. Well, there we go. To each its own.
When I go to the store, we get both.
You get both. Yeah, everyone's got to have their own choice, their own preference.
It's easier to keep both of us happy.
Absolutely. Well, happy wife, happy life. You know how I feel about that. But, when it comes to risk in a retirement plan, do you have clients who think that, let's just put it this way, pulp free, and then that's like the conservative retiree, some pulp, which is the balanced approach, and then you got the extra pulp folks that are aggressive out there. So how do you match that risk tolerance with a strategy?
I think it's what we do when it starts to come to people's overall portfolios, because we have those questions. I always ask people the question, if on a scale of 1 to 10, 0 being you're ultra conservative and 10 you're as aggressive as you can possibly be in the market, and you can't pick 5, which do you pick? The reason why I say you can't pick 5, because everybody wants to pick 5. I'm a 4 or I'm a 6. And the thing of it is how you ask that question, I believe, is very important. And when you ask that question, if markets are flying, people are 6, 7s, and 8s. If the markets are way down, they're 4s, 3s, and 2s. They're depending on the market. But I've also said, what is the amount of dollars that we're talking about? I think that's important. And what's the time frame? If you got money in your Roth IRA account, and you've got sufficient assets, you'll probably never touch those. Those will go to your kids. They got a longer time frame. I want to be more aggressive with those. Stuff that you're going to need for the next 6 months worth of living expenses, I wouldn't put it at risk in the market. I would take some of the risk away from that. So it all depends on what you're doing. And that's what I love about the way we do these things. One, I can do conservative portfolios if you're pulp free and you don't want any kind of risk at all. Mm-hmm. We've got some portfolios that manage that. We've got tactical portfolios that will move away from the market when the markets are declining. We have static portfolios that just kind of sit there and adjust when necessary or on an annual basis. And we got the individual stock portfolios. Now, the individual stock portfolios, as you can guess, are going to be a little bit more aggressive. We got it for growth. We got it for those people that want dividends. We do have it for emerging technology, the things that are going to be big 3-5 years from now. So we have a good mix for everybody, but we also have the availability to say, Steve, I want to participate when the market goes up, but I don't want anything when it goes down. Well, how do you do that? That's where the fixed indexed annuity comes in. Not one for income purposes, for protected growth. So being a holistic advisory firm that we can offer any of those things, I think it's the most important thing, because some people don't like investments. They want it all safe. Some people want it as aggressive as it can be, and they don't want anything safe. So you got that balance between those two things, and we've got the availability to get what you need. Where are you currently at? It's amazing when I ask those numbers and then I run the risk-reward analysis around people's portfolios, and they don't match at all. How much risk are you taking for the return that you're getting? Is it within your tolerance?
There are lots of folks out there like billionaire Bill Gates. He is 69 years old that didn't have, smartphones and social media when they were growing up. I know I didn't. Steve, I know you didn't as well.
No.
I know people today are going, how did you survive? But it's possible. We did. But he did play outside along with his friends and, of course, loved to explore. He also spent a lot of time in his room alone, reading and thinking. Gates says that these habits help contribute to the success that he's had later in life. And it got me thinking here, if someone is nearing retirement, let's say, 10 years or less here, what are some financial habits they can adopt both now to help them, be successful later in retirement?
Well, I think that's the big thing that people start to talk about. A lot of people have done what they were asked to do. Put money back for when you retire. We were told a long time ago, use your IRAs and your 401ks, defer. You're going to be in a lower tax bracket in retirement. That's what we were told. Well, I don't know if that's going to be true today. So I think looking at where you're currently at and what it's going to take to replace the income that you're not going, when that paycheck goes away, how are you going to replace that paycheck? So I believe that investment triangle should be covered with some things. One, do you have a tax strategy? 2, do you know how you're going to replace your paycheck? 3, have you figured out Social Security optimization? 4, estate planning and legacy planning.
Mm-hmm.
You know, a lot of us will pass on assets to our kids. Can we do that the best way possible? I believe our investment philosophies should be based on need, not greed. And I think we should have things in there to protect our portfolios unless they go down.
You know, it's been about 2 years since Rob Gronkowski, he retired from the NFL for good. He's recently joined Fox Sports as an analyst. And in a recent interview with Fortune magazine, he was asked what's the best investment that he ever made and who gave him the advice.
The guy actually who built my house, he told me, hey, buy Apple stock. I'm telling you, that's where it's at. You know, I never been involved in stocks. I really didn't know how stocks work. I was like, all right, I'm going to go big. I'm going to put $69,000 into Apple stock. And this was like 2014. So then all of a sudden I forgot about it. It's like 2.5 years later. And the stock is worth like $250,000. So I sell off the portion of the $69,000 I bought in. Now to this date, I have over $600,000 in Apple stock.
Okay, interesting. What a random tip from the guy building your house. Hey, man, this sounds like a good idea. Get into it. Lucky tip paid off for him. I'm sure you have clients come in all the time that say, my friend, my brother, whoever told me I should do this. What are your thoughts? How do you help guide that?
I like to look at it to the point, most people in this case, you know, I'm sure Tom Brady's not talking about his loss in crypto.
I'm sure he's not.
Yeah.
He probably didn't even feel it.
Most people don't tell the stories about the losers. They only tell the stories about the winners. And that's where you start to look at, I think people own an individual stock. I think Gronk had a pretty big, larger income than most of us out there.
Yeah.
So him being able to buy individual stocks is pretty good. I like the fact that when we start to look at it, for most people, I think the ETF portfolios are probably the best things that they can do. Why? It gives them baskets, gives them more diversification. As your portfolios build, I believe that having individual stock portfolios can be very advantageous, but I'm not big on the just buy one and hope type of a deal. I have a stock in my portfolio that I knew I was going to retire on. It's now worthless. I could write it off if I would just sell it, but I keep that thing sitting in my personal account. So when I get that great stock tip that I think it's going to allow me to retire very comfortably, I look at that stock and say, God, I remember when I thought that back in the 90s. So be careful on that one stock from the guy next door. Uncle Joe is always the guy that gives a lot of advice. So be careful from that.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.